Good afternoon, everybody, and welcome to the last in this current series of the Service Department News webinars. Today, we are going to look deeply into investment, finance, and M&A in the service department, extended stay, and apart hotel sectors. My name is George Sell. I'm editor of Service Department News, and we're an online B2B platform for the industry. Today's webinar is going to last an hour. We'd like to make it as interactive as possible, so if you've got any questions for our panel, please do submit them using either the Q&A or the chat function in Zoom. If you ask a question on the topic that we're covering at the time, we'll try and do it then, but if not, we'll save a few minutes at the end of the session. And a recording of the webinar will be sent via email to everyone who's registered. I just wanted to show a few screen grabs of stories that we've run on Service Department News over the last year or so, just to give you an idea of some of the topics that we're likely to touch on today. So you can see single asset sales, the big hotel groups investing heavily in launching new brands into the space. Blueground, who we'll hear a bit about, has been investing in other companies and buying other companies. We've seen mergers, the HomeLike and Q Global Network deal recently. And then on the next slide, we've seen some of the reasons why the sector is attractive to investors. It's very resilient to the staffing crisis, which is being felt across hospitality. There's another single asset acquisition there. Development finance for an apart hotel project. And then companies that have received investment going on to do really well. So Stay City breaking the €200 million turnover mark for this year. And they've also announced that they are going to be debt-free by 2027. So lots to get our teeth into and a really good panel to discuss it with. And I'm going to ask our panelists to introduce themselves. I'm not sure if Haroon is with us yet, so I'm going to ask Andrew to go first. If you could give us a quick introduction, Andrew.
Sure. Yes, I think Haroon is with us actually. Yeah, my name's Andrew Harrington. My business is called AHV Associates. Been around 22 years. Investment banking boutique specialising in hospitality. My background is investment banking, and we advise privately owned businesses in the sector on mergers and acquisitions and capital raising, and we do stuff all around Europe. Yeah, that's us.
Thanks, Andrew. Haroon, good to see you. Welcome. Haroon, are you there? Or maybe you're on mute. Let's go to Apostolos for a minute and see if we can come back to Haroon. Apostolos, good afternoon to you.
Yes, hi George, hi everyone. So Apostolos, I'm the CFO at Blueground. Blueground is the largest global operator of furnished rentals for 30-day plus stays. We currently have a portfolio of 15,000 apartments in 30 cities around the world, continuing to grow fast. The company is now 10 years old, and actually it was founded in Greece, and the genesis of the company was, in reality, a personal problem of the founder that he actually managed to turn into a very large business. And the personal problem that Alex was experiencing, it was the lack of furnished supply in the market when he was traveling for business purposes many years ago. So he basically ended up staying in 15 different cities in a number of hotels, and it was always so expensive, and the quality of the product was low. So this became the raison d'etre or the reason for basically building Blueground in order to create an easier way for people to live flexibly and comfortably around the world with high quality apartments available whenever they want them and at the terms they want them. So that's what Blueground is about.
Excellent. Thanks, Apostolos. Let's try Haroon again. Good afternoon to you, Haroon. No, I think we've still got a problem there. Well, let's crack on with the agenda, and hopefully Haroon will be able to join in shortly.
Yeah.
So let's start with a very broad brush question then. How is this sector viewed by investors, and how does it compare in terms of investor sentiment to other hospitality and real estate asset classes? Andrew, you've got quite a good overview of hospitality in general, and you've been interested in service departments for at least 10 years or so. So what are your impressions of where we stand at the moment?
Yeah, George, thanks. Yeah, no, I think, you know, we're in a completely different investment environment now than a couple of years ago. And that is we're in an inflationary world. I mean, you know, there's two things that are going to persist once interest rates and inflation come down. It will be higher inflation than the past, significantly higher inflation than in the past, and significantly higher interest rates than in the past. And so the whole dynamic of investment will change. Now, there's bucket loads of money around, right? And there's a desire to invest that money. And some people have views as to how to invest it. Others are more cautious at the moment. But there's a lot of money around. And the hospitality sector generally, it is very well positioned in order to take advantage of this, because the hospitality sector generally is one of the very few sectors where there's a real track record over many decades of being able to pass through inflationary increases in costs, right? Now, it's not all sectors, right? Apart hotels, service departments, for sure, great sector to be in. Luxury hotels, budget hotels, you know, anything with some form of uniqueness, etc. Mid-market hotels, well, some will, some won't. But as a sector generally, it is very difficult to think of a better sector to be in from an investment perspective if you want some form of inflation protection, right? And that is really important. And I think that that is going to be the driving force behind investment in the sector in the next few years. In addition to that, one other point which sort of relates to that, but is a different point, quite a lot of areas in the hospitality sector are very underpenetrated compared to, for example, the US. So apart hotels, service departments, classic example, there's all sorts of evidence to suggest that, you know, there's secular demand for this, right? That is independent of any point in the economic cycle. We're way behind penetration compared to Asia and the US, etc. In some parts of the country, there's a real, you know, under-penetration of budget hotels. I mean, there's a lot of these hostels, co-living, right? So there's a lot of arguments to suggest that certain sectors of the hospitality sector, there are secular trends as well, which complement the general inflation resilience of the sector. So, you know, I think, you know, the next few years are going to be really interesting. Certainly in my own business, we're doing business. We've got engagements in the UK, in Croatia, in Denmark, and in Spain at the moment. So that's sort of across Europe. And certainly I think those trends that we discussed apply everywhere. And it's to do with the resilience of the hospitality industry to inflation in general, and the attractiveness of certain sectors within that because of secular trends.
Thanks, Andrew. Haroon, good to see you. Rasmala has acquired a service department platform in the form of Flying Butler, now rebranded as Viridian. So what do you see as the main attractions of this sector, and how do investors feel towards it in general? Just lost Haroon again. We'll come back to him in a minute. Apostolos, Blueground is an interesting case study. As you mentioned earlier, the company was formed to address a gap in the market. Yeah. And in recent times, you've not only raised quite a lot of investment into your company, but you've also invested in other companies, and you've also been acquiring other companies. Mm-hmm. So you're in a good position to assess the investor sentiment to the sector. What's your general impression?
Yeah, that's it's a big question, this one. I mean, so it depends. First of all, I would say that it really depends how you look at it, right? One is, do you look at it from a real estate perspective or from a consumer product perspective, right? What, let's say, for example, we are doing at Blueground is we looked into the traditional rental process, residential rental process that an individual, let's say, would experience, and this would include a person going to check a neighborhood to find a nice building, deal with brokers, landlords, eventually get into an inflexible contract, 1 year, 2 years, 3 years to rent an apartment. They would need to buy furniture, move it around. All in all, a very cumbersome, inefficient offline process, which was also costly, right? So what we did is we innovated this process and we took it completely online at one click of a button and offering it in a flexible way to people. You want to stay for a month in London and then move to New York, you can do that with us. You don't need to be locked into a long-term contract. This became extremely important, especially post-COVID, where flexibility has been one of the top priorities of people when it comes to renting. And at the same time, we are obviously experiencing a wider move in terms of consumer trends, from owning assets to utilizing assets and maximizing experience, right? So we're seeing that as well. From that lens, my view is that investors understand that there is a massive addressable market. There is a lot there's tons of people looking for this product or this type of products or this type of solutions. But investors are also looking for companies that are able to monetize this addressable market and create profits, right? So this is really where Blueground has been at the forefront, because we have been able to scale and build the largest player in the market, but also do it properly. And this is why, as you mentioned, we have been able to attract capital. We have been able to become a natural consolidator of the market and getting a lot of confidence from the investor community. And I think companies that are able to demonstrate ability to get this kind of market share and do it profitably, they will be at the spotlight in terms of investor sentiment.
And the type of investors that have been attracted to your company, I found that quite interesting. Obviously, you've got GLO Capital, which is quite heavily involved in the hospitality sector. Its head is from one of the big hotel dynasties in the States. So do you think they were attracted to the hospitality and real estate element of what you do, or is it the tech side of things that gets the venture capitalist people interested?
I believe that investors get excited when they see companies that are actually tackling the space between real estate and technology, because they understand that real estate as an asset class has a number of pockets which are ripe for disruption. And the players who are able to build technology around these pockets and scale into a large addressable market, these become very, very attractive. So this is the reason why traditional hotel or real estate investors are investing into companies like Blueground. The same logic goes for VC funds, private equity funds, even real estate developers are doing the same, right? Because everybody understands the value creation that companies like Blueground is putting into the space. So this is what we see. I wouldn't point out that we only have a specific pool of investors that are interested in the company, right? We've seen a wide variety of capital allocators and strategic players looking into our space and the company specifically.
Yeah, great stuff. Thank you, Apostolos.
Yeah.
Haroon, good afternoon. Can you hear me?
Yes, George. I could hear you. I believe I couldn't be heard. So.
No, excellent. Well, you're loud and clear now. Good to have you here. Haroon, could you give us a quick introduction to yourself and Rasmala, and then tell us what it is about the service department sector that attracted you to become involved and acquire an operator here in the UK?
Certainly. Thank you for having me. I'm based out in Dubai. We are a boutique investment management firm managing about $2 billion of institutional assets from investors around the Middle East, primarily UAE and Saudi. And as you well know, the love affair between the Middle Eastern investor and UK real estate that's continued for the last maybe 50, 60 years. And a few years ago, we were involved in a transaction where we acquired a stake and then grew that stake and took majority of a operator on the ground, Flying Butler, a really nice niche team with niche assets and particular good coverage around London and the Southeast as an operator of service departments. It's been recently rebranded as Viridian Apartments, and we're hoping to grow that business to over 1,000 apartments in the next couple of years. Service departments is very, very niche. I mean, of course, Middle Eastern investors have looked at UK residential, London residential assets, on particularly hospitality assets as well, student accommodation they've looked at. More recently, they've been looking at healthcare assets, nursing homes. All of these sub-segments have attracted investors from the Middle East. But particularly service departments has a very nice story. There's increased yield, and also in terms of the locations, it has a genuine attraction around it. It's the fact that there's operational real estate around service department which can derive higher yield, which particularly interests our investors. And I think it continues to hold interest with us, despite the fact that where we find ourselves in the interest rate environment, it's challenging. But we continue to see the larger players, the sovereign wealth funds deploying money into the service department segments, as well as BTR as well.
And is your strategy primarily to grow as an operating platform for assets in other ownership, or are you acquiring assets for your operating platform to take over, or a bit of both?
We're opportunistic. There is, as the market it goes into stress, I don't think it's distressed yet, but there certainly is some stress that you can see with some developers. We've looked at some development opportunities which can eventually move into where the operator comes in. We've recently launched a UK multifamily strategy under a REIT structure out of Jersey, and it has 4 verticals, one of which is service departments, but others include the student accommodation space, as well as BTR and senior care. And these are the 4 verticals that we're primarily looking at London and just outside in the Southeast region. But as the market improves, as the debt environment improves, inflation gets under control, I think there will be more opportunities to grow. What we've also done is within that strategy, within that fund, we've incorporated the operator within it, within that structure. So the investors get the benefit of both the operator as well as the real estate around it. Excellent.
Thanks, Haroon. Andrew, as the sector matures, is the investor profile changing at all? I mean, who are the main players, and how is the type of investor involved in the sector evolving?
Well, I think, investment, ultimately all comes from the same place. It's savings and pension funds, all that sort of stuff. And it's channeled through a variety of different sources, and those, private equity, family offices, et cetera, and that structure will stay. And I think what we're seeing is a real move away from a sort of more traditional way of looking at stuff. I mean, Haroon talks about yield, and yield is a way that real estate investors look at stuff. But in a high inflation world, yield is actually large. The current yield, today's yield, is actually, it's not particularly helpful. Because if you're in an inflation-resilient sector, you start out with a yield of whatever it is now, and in 3 years' time, it's 25% higher because of inflation. If you're in an inflation-resilient sector, so what you'll see the yields of those assets. If we're talking real estate here, the yields of those assets which are the most inflation-resilient will go down. They won't go up; they'll go down, right? Because and if you're exposed to the P&L. Right, so hybrid lease or management contracts or full ownership, then you'll see those yields go down because of the inflation resilience. And your standard straight lease, right, with anything other than a top operator, they will go down big time in value, because straight leases in an inflationary world, unless you've got a real top-notch operator who can withstand inflation increases in the rent, you know, that they become less valuable. And I absolutely think we're moving towards a US type model here. You know, in the US, the vast majority of hotels, part hotels, service, you know, whatever you want to look at, they are management contracts or hybrid leases or ownership, right? Operational, that's what I meant to say. They're not straight leases. So we're moving towards a US world. I have no doubt about that. That world has been around forever, et cetera, et cetera. There are some issues with particularly German pension funds and stuff who have to have fixed income, and okay, that's fine, but they will be the last to move. But in the meantime, I'm certainly seeing it right now. You know, most of the professional investor world, you know, are moving towards hybrid leases, full operational real estate, management contracts to get that degree of inflation protection.
And Andrew, how does that affect investor sentiment towards investing solely in an operating platform, or do most people want to have a bit of skin in the real estate game too?
No, I mean, you know, it's horses for courses. There are some people who, I mean, at the end of the day, I come from an M&A background, not from a real estate background. So to me, they're all businesses, right? And there's been this sort of largely artificial distinction between bricks and mortar here and operating businesses here. And I sort of understand why, but the world is more complicated than that. Even a piece of real estate with a lease is a business, right? There are risks associated with this business. And in an inflationary world where the risk of inflation is much higher than it was, you know, there's much more priority given to, as I said before, to getting exposure to the P&L, because that's where you get your inflation resilient type returns. And, you know, we're certainly seeing, I mean, you know, KSL, for example, I mean, they don't just focus on real estate. They buy operating platforms, et cetera, and they use it as a means to grow a hospitality business. So there will still certainly be demand for real estate because people feel safe and secure and all that sort of stuff with real estate. But in reality, they're all businesses, right? And there are plenty of professional investors who will look at operating platforms, you know, because the risk-reward profile, you know, looks good. And if they happen to own some real estate, that's great. If they don't own real estate, that's fine.
Okay, thanks, Andrew. So we've established that there's a lot of dry powder out there waiting to be invested. But what about debt? How accessible is debt, either for developing new assets or acquiring assets, or indeed other companies? Haroon, what's your take on that?
George, I'm actively in the market right now trying to acquire debt for a couple of the acquisitions that we've done, and there's plenty of interest. The key becomes LTVs and the pricing and how quickly they can move. But certainly there is capital. The quickest capital seems to be like almost the smaller outfits and debt funds, which are able to structure something which can work on a variable rate mechanism, and no one's locking in any rates at these rates. We expect over the next couple of years the rates to come down and for it to become more attractive. I completely agree with Andrew. The inflationary environment that we have right now with the core inflation where there is, you want to be in an asset class, and you want to be investing where you can keep on increasing the rents as inflation feeds through into the system. And therefore, service departments on shorter leases, shorter rents cycles is an attractive place to be. The longer the lease length with fixed uplifts, the harder it is to protect the asset value.
And across the various asset classes that you're involved in, you mentioned build to rent as well earlier. Has the current inflationary environment and the debt landscape, has that altered your plans to acquire more assets for your companies to operate? Has that changed your thinking, or are you kind of looking beyond that to the medium and long term?
So BTR in around London is where we've been looking, but you want to have at least 100 apartment building with amenities and you want to have a low leverage, low LTV scenario in this, and so stacking up these things is slightly problematic right now, because there's not a huge amount there's a lot of money chasing those sort of assets. So working with developers to see how we can work aside, get consents, or convert existing office structures to residential assets, BTR assets. That's where I think the opportunity is. But it will come through over the next couple of years that you can build up a nice portfolio. That's what we want to do. We want to build up a nice portfolio of BTR, service department, student accommodation, which we can then take to listing in a few years' time.
Okay. Andrew, what's your take on the lending landscape at the moment, and how do you see it evolving over the next couple of years?
Yeah, well, the starting point is bank balance sheets are very strong, and there's huge amounts of money in debt funds. Obviously, with interest rates having gone from nothing to 5%, then a lot of projects simply won't stack up, right? And that's what we're seeing. Development projects, in particular, need to be changed because they don't stack up in the new regime. That usually means more equity, et cetera, et cetera. But there's still funding there even for that. I mean, it goes back to what we were saying before. If you want to borrow money, right, for an asset where there's good reasons to believe that there's inflation resilience there, right, then in your modeling for that asset, you have to take that into account. There's no point in predicting ADRs in 2 years' time, which are the same as they were 2 years ago, because they're probably going to be 20% higher if you're in an inflation resilient asset. And that makes a difference to the funding. And you'd be surprised at the number of people who actually forget that fact, actually. If you believe that there's going to be inflation and this business, a particular business is going to keep pace with inflation, then you've got to factor that into your model, or else you haven't the hope of making it work. So there's lots of funding around, lots of funding in banks and debt funds. I think with development projects, many will be funded, maybe at a lower level of debt, more equity, etc. The other thing is, I don't think loan to value is terribly helpful in the current environment. Talking to lenders, they focus on interest cover ratios, right? ICR is the key thing here. And they stress test the ICR, the interest cover ratio in particular. So some won't be funded, many will. There's clearly going to have to be a change in modeling. It has to reflect inflation in the future. Development projects are the real area where there's a reluctance amongst many lenders to lend, but even those, the best ones, the good ones, will be funded. But the structure may have to change.
Thanks, Andrew. Apostolos, Blueground has grown quite rapidly over the last couple of years, and adding inventory is obviously key to keeping that growth going. When you are speaking with your landlords, your building owners, are the challenges that they have in developing affecting you in your quest to add more inventory to your portfolio?
Look, I mean, there are a couple of points here. Ground up development takes time. Okay, it takes years. Also, a conversion, a change of use from an office building to a residential building also takes years. For Blueground, speed has been the main thing, right? We have always been trying to grow fast, putting a lot of attention into the underlying economics of every deal that we make. So for our landlords, the main questions have not so much been, getting into new developments, rather than how do we improve NOI for our existing buildings? How can Blueground help us improve profitability for the buildings that we have, right? And the value proposition there has always been very, very strong, because what we do is we offer 100% occupancy to the landlord. We pay market rates, and we minimize all other expenses, so marketing expenses, releasing. And at the same time, we operate actually a very strong marketing engine, because we have a lot of footfall in the buildings, high quality tenants of Blueground. They go into the buildings, and after a while, they may go and rent an unfurnished apartment of the same landlord. So landlords have always appreciated that. I believe that we are perceived as an NOI optimizer in the market for landlords.
Okay, and we mentioned earlier that you have also been quite acquisitive. You've bought several other companies. So what are the pros and cons of being so acquisitive in this current market? What's the rationale behind that strategy?
I believe that in any market context, a company has to have a very clear growth strategy and a very clear M&A strategy, right? And this is the first thing we did at Blueground. Is we sat down and we discussed and we built a very clear corporate development strategy and M&A strategy, right? In terms of getting into new geographies and also having access to new product and new technology. And this is what we have been executing on. The benefit of being in this specific market context is that, number one, good companies are more easy to showcase comparing to worse companies, right? The good companies are distinguished. So good operators are more evident. So we've been able to identify good companies. And because of the fact that we are the number one player and the strongest business in the sector, we have been able to create partnerships and execute on M&A transactions using also the company's equity as currency as well, right? So I think being able to execute on a clear strategy, being able to leverage on your own equity instead of utilizing external debt or cash is important. And also the ability to identify suitable targets with the potential for a successful integration is the third component that we have been always be very thoughtful about. Of course, there are risks, right? There are execution risks when it comes to M&A. Everybody knows about it. There's a very large percentage of M&A transactions that are not successful because they're not able to capture synergies or the drivers of transactions. So again, this connects to the points I made before about having a clear strategy and how you execute about it. So yeah, that's how I've been approaching it.
Thank you. Haroon, you used the word opportunist earlier. So would you consider acquiring other companies, or are you set on a course of more or less organic growth for your platform?
No, we are looking at opportunities from an operator perspective as well, especially if it can dovetail with our 4 verticals that we're looking to invest in on the residential side, and certainly the more specialist senior care, even student housing. There's very specialist operators around which can fit in well with our strategy. We, in the last few months, have been quite active on the fundraising side and putting ourselves in front of investors, institutional investors here in UAE, as well as Saudi, Qatar, and Kuwait. We can see the value that it does bring to have an operator close to these real estate assets that you acquire, and the value in. I think Dominic, our CEO at Viridian Apartments, used this word of sweating the assets, and to be able to really drive value, and especially in the environment that we find ourselves, where costs are rising, and we need to make sure that these assets really deliver value for our investors. But yes, opportunistically we are, and we do see, and we continue to survey the field. There's a lot of investors who directly gone and acquired a stake in developers, in operators, to be able to get access to the deal flow, and that's another area we're focusing on.
Yeah. Okay. Thanks, everyone. Andrew, where do you see the sector in general in terms of M&A? Do you think we're going to see more of it in the next couple of years? And can you see any of the really big players changing hands?
Yeah, I mean, we're already seeing it now. I mean, you know, the consultants, the brokers, all saying deal flow is going to pick up in the 3rd quarter. Well, you know, if it picks up in the 3rd quarter, it means it started in the 4th quarter last year. or the first quarter this year, and that's certainly what we're seeing. You know, I think that some of the big players are already being marketed, to be honest, without mentioning too many names. I mean, you know, some of the big players in the apartment hotel space and the service department space, the hostel space, you know, already being marketed, maybe officially or unofficially, but they're certainly being marketed. Certainly in my own business, you know, we're, you know, of the work we're doing, we've got, you know, quite a few M&A engagements where we're advising on acquisitions or sales, and we're, you know, quite far advanced. I mean, who knows whether or not they're going to close? So you only know that after the event, right? But there's certainly a lot of interest, a lot of capital, etc. So I think actually after a couple of years of really quite poor M&A activity in the space, right, because of COVID, I think this year, next year is going to be really, really, you know, much better than it was. At the same time, other sectors, of course, it's going to be worse than it was in the last year. So for all the reasons I mentioned before, in terms of the particular attractions of the sector and the substantial amounts of money that are still on balance sheets and in funds, I think you're going to see M&A really pick up. And it already has, actually. If you look at the statistics, first quarter was a lot better than a year ago. Second quarter looks even better. So, you know, I think it's already happening, and that will become apparent over the course of the next several quarters.
And just to go for a slightly different take on the question I asked Apostolos earlier, what are the opportunities and challenges of being acquisitive in this current high inflationary environment?
Well, there's only one reason to make an acquisition, and that is to accelerate the execution of a strategy, right? I mean, that's why everybody makes acquisitions, and acquisitions have risks and rewards, and you know, there's an old saying in the M&A world, of course, acquisition or transactions happen when the buyer thinks it's cheap and the seller thinks it's expensive, right? The reason why a seller would sell is because he or she thinks they're getting good value. The reason why a buyer would buy is that he or she thinks they're getting good value, and it's where the two meet. That's when transactions happen. Now, you only know a year afterwards whether or not it was a good acquisition. I mean, I've never met a buyer who says, you know what, I want to overpay, right? All buyers say they don't want to overpay. Well, of course, it's like sun rises in the east, right? The fact is transactions happen when both sides meet, and there are risks associated with every transaction. And as long as, when we're acting on the buy side, as long as the buyer understands the risks, right, and does their best to mitigate them, then that's the best that they can hope. That's the best that they can hope for. Fortunately, in this sector, you know, the variables are quite limited. You know, there's not a lot of variables to play with, right? You know, with a you know, it's sort of ADR, it's occupancy. If you've got a bit of food and beverage, there's some food and beverage. You know, there's the competition set, and what else is happening. There's not a lot of variables compared to, you know, other sectors, and that is attractive from an investor's perspective.
Yeah. Okay. Thanks, Andrew. Let's go on and talk a bit about emerging markets and geographical regions that we think might see a good amount of investment, and why. Apostolos, can you sort of outline where the Blueground portfolio is, which territories you're in, and which ones you'd be interested in gaining a foothold?
Yeah, so we operate in about 30 different cities. Majority of the portfolio is in the United States. We have a big presence in Europe and the Middle East as well. And we have started doing some more work in Asia recently. And through Tabas, we have also established presence in Latin America, starting in Brazil. Going forward, the focus areas, I would say, are Latin America and Europe, from a diversification perspective, and also the fact that there are markets there where real estate ownership is more fragmented, and there is significant potential for a company like Blueground making a difference and having a strong position in the market. And at the same time, we will obviously keep growing in the US based on the existing presence we have and expanding further our relationships with big landlords and big developers actually across the country. And Travel is Heaven will be also supporting that growth plan of ours.
Okay, thank you. Haroon, you mentioned that a lot of your activity to date has been focused on London and Southeast England. What are the particular attractions of that area, and where else would you consider looking? Where would you broaden your focus to?
I see the vintage of this year where there is opportunities. London seems very attractive to us. It will, once it comes out of the dip, the economy in London will always recover faster than other areas. There's more liquidity around London, central London, and we see a lot of good transactions coming to the market. Some prices that we have not seen for a few years. Having said that, certainly Manchester, Leeds, Sheffield, Nottingham, Bristol, these from a student accommodation sector, these geographies are very attractive to us. We continue to see opportunity. I mean, as a house, we continue to see opportunities and other development opportunities in logistics. And that's in Europe, we're doing a project where we're developing a logistics warehouse facility for one of our existing tenants. Further afield, we, of course, our home domestic markets here in the Middle East are doing well with oil prices where they are, and a lot of domestic deployments from governments and the private sector and real estate markets here in Dubai, in UAE, certainly in Saudi. The influx of investment is strong and continues to remain strong. Of course, geopolitics plays a part in this as well, and certainly Dubai has been a recipient of that, or benefactor of that play. And we continue to see opportunities investing in real estate here in Dubai through development opportunities primarily. Slightly further afield, if you look towards Asia, I take the point of looking at Latin America. It's not something that we are close to, but certainly India and the Southeast Asia, there is a lot of interest in the equity markets there. And so we continue to look at opportunities in the listed market, listed space there.
Great, thanks, Haroon. Andrew, let's talk a bit about green finance. Tell us how that particular sector is evolving, and where the service department and extended stay sector is placed to capitalise on that, and if it isn't placed to capitalise on that, what it needs to do to capitalise on that.
Well, I mean, I think the whole area of green finance is set for major change, isn't it? Because we've got standards, internationally approved standards starting to appear. I think is at the end of, it's end of June, end of July, we're going to get the first lot of standards from the Accounting Standards Board, and the whole thing is going to become a lot more serious than it has, right? And there's going to be real accounting tests in terms of, excuse me, in terms of ESG standards for new buildings and for existing businesses, etc. And over time, that will be reflected in bank reserve requirements, etc., etc. So, you know, the whole area of green finance is going to really come to the fore even more so than it has been over the course of the next few years. And, you know, also the other thing that is happening and will continue to happen is that consumers, I mean, ultimately all this stuff is driven by consumers, isn't it? Right? Consumers want to know, or many consumers and an increasing proportion of consumers want to understand that where they are staying complies with the relevant ESG standards, because, you know, an important proportion of the consumers are the under 30s, and they will increase in who are most active, who are most energized by this, and that is increasing. And if you, in the US in particular, right, requests for proposals from technology companies in the US and many other companies now are full of ESG type questions about how you conduct your business and how you're caring for the planet. And that's all going to increase, and there's going to be a layer of regulatory requirements on top, driven by the accounting standards and in due course the reserve requirements that the banks will have to abide by. So it's all going to become a lot more important than it has been, and it has been important.
I agree with you that in the future it'll be driven by the consumer. I personally don't think we're there yet. I think it's still the investment community and their ESG criteria that are driving things, particularly on the real estate side. Apostolos, it'd be interesting to get your take. So when you were seeking investment, and also when you were investing in other companies, did their ESG strategies have any bearing on you?
ESG is an area that we're taking seriously at Blueground. So I think I'm hearing some.
Yeah, we have somebody else. Here's somebody else who I can't see on my screen. It's a bit strange.
Yeah. So we take ESG seriously. I was saying, and this starts with us as a company, right? So as an example, we have been able to utilize now furniture that is more durable. Has more sustainability in terms of materials. We don't need to, replace them fast. It takes many years to replace. When we do that, it's easier to recycle. So we do that. We have, partnerships with electricity companies to optimize electricity consumption, minimize emissions. So everything starts with us. And the same culture and the same logic we want to embed into the companies that we partner up with or we invest into, right? So this is an important aspect. We recognize that many companies in the startup world or early stage world do not necessarily focus on this aspect as they focus on growing and building their business. But for us, we have it in mind, and we try to execute on our strategies in line with the ESG principles.
And when you were raising investment yourself, was there significant interest in your ESG strategies from investors before they decided to commit, or did they realize that you were still very much in the growth stage and it wasn't as high on their
For us, we saw our main investors focusing more on ESG over the last couple of years. So I believe it was a couple of reasons. One was the general maturity of the ESG kind of space in terms of requirements from banks, lenders, IPO advisors, and the markets themselves. But also the fact that Blueground as a company was growing and was more able to address ESG issues that were pertinent to the business itself. So we see that now. We've been seeing that over the last couple of years.
Yeah. Okay. Thank you, Apostolos. Okay, so we're getting close to 3 o'clock. I just want to finish off by asking each of you in turn how you see investor sentiment towards the sector and investment activity in the sector, how you see that evolving over the next 2 to 3 years. And I'm going to start with you, Andrew.
As I sort of mentioned before, I think that the next few years are going to be really good for all the reasons I mentioned: the attractiveness of the sector, for secular reasons in many parts of the sector, for the inflation resilience of many parts of the sector, for the ability to, for the simplicity of the sector. I mean, a lot of funds are interested in the sector because it's actually pretty easy to analyze, and there's decades of data, right, to assess. So, I think a number of trends, lots of interest from professional investors, particular interest in operational real estate, hybrid leases, management contracts, diminished interest in standard leases, except in really city centre sites with the best operators, right? And a focus also, I guess, within all that, a focus on the subsectors which have really good secular trends: co-living, apart hotels, service departments, parts of senior living, right? Interesting what Haroon said, parts of senior living, assisted living, PBSA everywhere, right? Because there's such a boom in PBSA and it's just going to continue and continue. Probably even within PBSA, you're going to start to get graduate-focused accommodation rather than undergraduate-focused accommodation. There's all these sort of sectors. And there's a hell of a lot of interest in it and not enough supply. So call me Mr. Optimist, but I'm actually really bullish in the next few years.
It's good to hear. And it's also interesting that you say there's decades of data to look back on, because I can remember particularly the first couple of years after we launched Service Department News in 2013, I think. One of the things we used to hear all the time from lenders and investors was, well, there's no performance data, there's no benchmarking data. So it's good to see that we've come a long way.
George, there is the last 10 years in service departments, apart hotels in Europe, but there's decades of data in the US, right, for that product. And in the UK and Europe generally, there's decades of data from STR and stuff like that for the hospitality sector generally. That's the point I was making, really.
Apostolos, how do you see things evolving over the next few years?
So I have a bit of trouble hearing because there's a background noise.
I really don't know where the other voice is coming from. Andrew, could you just mute yourself for a second? Let me see if we can isolate it to. There we go. That seems to have done the trick. Yes, Apostolos, I was just asking if you could give us your view on how you see investor sentiment to the sector and investment activity in the sector evolving over the next 2 or 3 years.
Yeah, I think this goes back to the point I was mentioning at the beginning, which is there is a lot of capital. The investors are there, the capital allocators are there. What is happening is that they're waiting for the right opportunity to invest. And the right opportunity in terms of the company, let's say an operator, it's operators who are actually able to scale and generate profits, right? This has been a difficult puzzle to solve in our space. Not many, if any, have been able to do that at scale, right? Because this is important. Growing at scale and generating profits. So this is what investors are looking for. I believe that in the next few years, there will be more investment into the space, particularly after having a couple of success stories first. So Blueground being one of them. I think there may be one or two more in adjacent markets, and this will drive more confidence and will drive more deal flow in terms of investment. So this is what I feel will be happening. And what remains to be seen is how large incumbents or large players will be reacting to this trend.
Excellent, thank you. And Haroon, same question to you to finish off.
I'm also an optimist, so I will concur with the panelists that there is significant opportunity. I would say that for dollar-based investors, looking at a UK from even a currency perspective, we had that dip where the currency went down all the way to 105. It's recovering back to 128. I think we will still see some volatility in the currency markets. Will give opportunity for US dollar-based investors to pick up assets in UK. And in particular, in this segment, if you have a very strong operator on the ground aligned with your deployment strategy, that will give you the edge. Certainly in terms of data, rental data, acquisition data, price data, the UK market is still much better than other markets, and certainly the legal system, where we do see the vintage in the next 12 to 18 months being a good time to deploy capital into good assets, which will protect against inflation and bring decent returns to investors over that period of time. Thanks,
Haroon. Although I am hoping that our next Chancellor doesn't single-handedly bring the exchange rate down to $1.05. I hope there's nothing that drastic going on. Let's say. Thanks everybody for your input today. That was a really interesting session. I just want to show a few slides before we wrap up, and we're going to leave the session open with the countdown clock for a couple of minutes at the end, so you can do things like take notes and connect with our fantastic panelists on LinkedIn. So as I mentioned at the start, this is the last in this current series of Service Department News webinars, but we'll be back in September on the 21st, when we'll be taking a deep dive into the economy extended stay sector. The link to register for that session is in the chat. And just a quick note for our flagship event, which is taking place very soon, the 5th and 6th of July in London at Canary Wharf, the Urban Living Festival, which looks at the increasing convergence between various living and hospitality asset classes. It's a great event, it's really interactive, and the link to get tickets for that is also in the chat. If you'd like to work with us at IHM, either on our digital or our in-person events, then please get in touch with one of my colleagues, Jordan or Stephanie, whose details are on the screen, and again, also in the chat. And finally, thanks to Andrew, to Haroon and Apostolos for their contributions today. Thanks to you for watching. Give us a follow on any of the social channels you can see on the screen, and I'll see you all back here in September. Thanks very much, everyone. Goodbye.